Hey, Rick Soukoulis here. Time for a little mortgage math. As you know, I live here in Silicon Valley, and there's a lot of action here happening with Silicon Valley Bank. And I'm going to try to put this into a way that mortgage people can simply understand what's going on. I want to tie it in with what's happening in our world because that's what's important, right? So, in our world, we have mortgages, and we're always following 10-year treasuries in the bond market and what's happening with MBSs, kind of see where prices are going, right? So last week we had, the 10-year treasury. Oh, by the way, I've got my little voodoo stick. If you're not old enough to know what that is, Google Ross Perot. I had surgery on my shoulder, so I'm going to be pointing with my voodoo stick. Anyway, back to topic here. So you have 10-year treasury bills last week hit 4%. 2-year, we're at 5%, which meant that you could put your money on a shorter duration or a shorter length of time and get a higher interest rate. But if you wanted the price guaranteed for 10 years, you'd get 4%, 2 years, 5%. So what happens if you bought a bond and you needed to get your cash out before the 10-year period? Well, you'd sell it. And you'd sell it at what's called a discount. It's the same relationship we have in mortgage rates. So if you look at the beginning of any week, let's say 6 3/4 is the rate we're going to look at. Maybe today it's at par or 100. And maybe tomorrow it's at 101, which means you'll get, if you borrowed $100,000, they give you $101,000, right? They're going to pay you above a premium, but a discount's where you're looking at 99 or points. And that way you can have an interest rate that you can offer, and you can compensate for fluctuations in the market or the price of the bond based upon the discount. So what happens here now that we understand that sort of background and that relationship and the discounts, let's talk a little bit about banking and Silicon Valley Bank in particular, and how they got a little bit sideways to the tune of $175 billion. Okay, so this is called fractional reserve banking. That's our U.S. banking system. And there's a lot that happens above this line with the Federal Reserve that I'm not going to get into. But when money gets into the system, it then gets in the hands of businesses and others who make deposits at the bank. They deposit their assets. Well, in basic accounting, you have assets and you have liabilities. So the bank brings in the asset, but it creates a liability because they owe somebody for it, right? Now the bank's in debt. So what happens is Silicon Valley Bank had $175 billion in deposits. Their deposit base grew very quickly. A couple of years ago, it was only $60 billion. How'd that grow so fast? Well, they serve venture capitalists. 80 to 90% of their deposits were to venture capital firms. Those companies lend companies money, or invest in them, I should say, buy their stock, and they encourage those companies to bank with Silicon Valley Bank. Nice, tight little relationship. Everybody's in the same game here. And then a lot of those, new to the market companies that have raised venture capital, some of them, financial services isn't their thing. So I get my $10 million from the VC guy, woohoo, I'm just going to put it in Silicon Valley Bank and have it sit there. The problem is, anytime you give a bank more than what's insured by the FDIC, you've given them an unsecured loan. So you put in $10 million, but only $250,000 is guaranteed. Well, but my money is still there. The bank has my money. Maybe. Watch what happens. So Silicon Valley Bank, their base grew very quickly. We take those deposits, they get reclassified as what's called reserves. So what does a bank do with its reserves? Got $175 billion. You got to keep 10% of it available for customers to come in and get their money to run your bank. The rest of it, the excess reserve is what it's called. Isn't that a great name? An excess reserve is available for lending. Now, if I don't have any loans and I want to be prudent, which it looks like Silicon Valley Bank was doing. They didn't have enough loans to make. They'd given all the entrepreneurs lines of credit that they could give. They'd done what they thought was prudent, and they had excess cash. So they did something very smart, one would think. They put it into treasury bills. They're safe, they're secure. But if you took out a treasury bill last year, what were you getting paid? 0.25%? Half? Nothing. The drill bit, right? So as rates start climbing up and everybody's talking about this inverted yield curve, that's bad for a bank because basically my old bonds that I bought, so they took a bunch of this money and bought bonds at a lower rate. Now I need cash. Now I got to go get some money. I go to sell my bonds, and now the market for the 10-year bond is at 4% or 3.5%. And I got a bond that's only paying 0.5%. I have to discount it. And depending on how many years are left on the bond, it could be at 1% discount. It could be 10. So those bonds get marked, and all of a sudden they need to go get $2 billion in capital. Oh my goodness, I don't have $2 billion here. Whoop, better sell my shares in the bank and get the heck out of here. And then I'll go and I'll raise some more capital. But before I do that, I might drop a dime and let a few of my buddies know what's going on. So you get what's called a bank run. Overnight, $2 billion leaves. So if the bonds had moved, let's say that $17 billion, the value of their bonds changed by maybe $5 billion. I don't know the exact number. The ex-CEO of Fannie Mae, Tim Mayopoulos, is going to be in there. I got to serve on Fannie Mae's board of advisors when he was the CEO. Great guy. Fannie Mae, Freddie Mac, their business is about risk management. He's going to get in there, straight shooter. We'll know exactly what happened. It'll all be told. But in the meantime, they came up short. So they came up short. They had no way to get the money. So what happened? The government steps in, guaranteed the depositors. So they take those deposits, and the losses on their loans aren't even realized. You hold that bond to duration, you're going to get your money back. Problem is they couldn't hold it. So now, can the new bank hold it or the government? Sure. So they'll work this thing out. They'll move through that process. We'll learn more about what's happening. But really what's going on and how it affects the banking system, it's really tied to the way our banking system works. The moral of the story is if you are blessed enough to have more than $250,000, spread it around in a few banks or have multiple accounts that have different titles on them, at a single bank. But here's how it's going to affect real estate. Okay? So I talked a little bit about the RSUs earlier. I think we're going to see that change. You're not going to be using that for qualifying income. The venture capital firms and the companies going public that were creating quite a bit of cash out here on the West Coast, we're not going to see the technology public offering window open up for a long time. And that was part of the reason why the big scare, because the notes that the bank did hold, a lot of them were tied to private companies that were going to go public from the venture firms that the bank had invested in. So I think it all gets worked out. We have First Republic here, another neighbor of ours, that stock is under pressure. We had another bank fail. So we'll see over the next week how it plays out, but really no big need to panic at the moment, I don't think. Do what you think is right for you. But understand that our monetary system is a fractional reserve banking system. Anytime you have over $250,000 in a single account with a bank, you've just given them an unsecured loan. And what you just watched is how it should play out is all of those depositors should have been out their money. But, that's not the way it worked today. Everybody's getting covered. And there'll be a lot of talk about what that means to the system in the coming years. Hey, I hope this was helpful. Give me a note on your thoughts.